live from CNBC TV18's headquarters in Mumbai. This is Opening Bell with Udayan and Mukherjee.
Good morning. Welcome to Morning Call, the last trading day of what is turning out to be an important week for the market. Today is a crucial session out here. Yesterday, many support levels got broken. It was an important day for the earnings calendar, and we did not come out of that with flying colors. Today is another very important session with bellwethers like Reliance, Bharti, ITC, Punj Lloyd all declaring numbers. So today is another make or break session from the earnings calendar. And globally, things have just got tossed up a bit over the last couple of days. And yesterday's 2% cut on the US market will be slightly unnerving for traders after what has happened yesterday. So the backdrop is tricky, and we will probably start with losses once again this morning. Mitali, good morning.
Hi, Udayan. Morning. It's a bit of a body blow for the US markets, and unfortunately it's not a peripheral Dubai kind of event. This looks quite serious.
Yeah, there have been some headwinds which have been building up for the last couple of days, Mitali, and today's cut on the S&P, or last night's cut on the S&P will not please traders who would have been hoping for a bounce back today after yesterday's very sharp cut. Aside of the China fears which continue to linger on the market, we were talking about the banks yesterday and Obama's statements about banks and how he wants to curb their freedom, and the latitude that they have today is coming as a little bit of a negative surprise. Having said that, if you put all of those things together, what he said about banks and how much has happened in China, are they enough in themselves? Are they such bad news that will break the back of the market? I'm not sure about that. But sometimes markets don't need reasons to correct. They just correct by themselves. And I think it's one more of those kind of phases where the news flow is not as adverse, which will lead to some kind of panic out there. But maybe a correction was overdue, and the market has just started some kind of a correction. And these headwinds on the margin might actually have just precipitated it or triggered it off. So I don't think the news flow is terrible, though there will be a lot made of it. But the market seems to be just correcting on its own now.
Which is the question on how much it can correct. I mean, just as an example, the SGX Nifty is precariously holding on to 5,000.
Oh, we'll fall more today in the morning for sure. And then comes the test of 5,000 and whether we can manage to pull back from there, because we did slice through some very important support levels yesterday, and we'll get precariously close to that very important psychological mark flashing on the screen of 5,000 Nifty. And to mix things up, it's not just the global events, it's one big earning after another staggered through the day. And after yesterday, I think the appetite or the tolerance to take any more negative surprises from the earnings season has been thinned down. So approach the market a bit cautiously today and pray that we come out in one piece by the end of it.
Of course, the immediate question today then will be where the Nifty will find support.
Well, the first stop is 5,000, and everyone who's on the bullish side would be hoping that 5,000 holds out, because it makes a huge psychological difference. It's not about the technicals, but to see the market at 5,000 something and 4,000 something makes a bit of a psychological shift for the trader. In any case, what I think happened yesterday was that a lot of the stop losses for many of the position traders would have got taken out. I think at 5,300, people who were playing for the 5,500 trade would have kept their stop losses at 5,180 or 5,150, thereabouts, broadly speaking. And after L&T came in, the ease with which the market sliced through those levels, I think would have triggered off many stop losses, which is why the fall from 5,180 to 5,100 was rather quick. This morning too, the 5,100 stop loss, the deeper stop loss gets taken out. There is no rebound in early trade. But at 5,000, maybe some of the near-term shorts which had been created may cover up, but despite the bad news globally, and then just wait and watch and see if the Nifty is breaking that level. So expect a fall to just above 5,000 kind of levels in the early morning trade, and then an attempted pullback. But the key question is whether the attempted pullback actually holds out and you manage to claw back above 5,040, 50 and then close around somewhere there. The one thing which this fall has done, Mitali, is also that complacency has been shaken out of the system, because earlier we were in a 100-point range, 120-point range for the last 3 weeks nearly. And that had led to, if not euphoria, there wasn't any euphoria, But there was complacency that what is the downside? If it falls, it will fall only till 51.80, max 51.50, and will remain in this trading range. So now I think traders have been jolted out of that complacency after yesterday's fall, and that's never a bad thing.
It is disturbing, though, to see the kind of cash selling this market is witnessing, the way there's a churn towards the options, and I mean, basically for this month, the kind of money we've lost versus anyone else in this region.
Yeah, there has been some cash market selling, and it is masked by the primary issuance sucking in some amount of foreign capital. So the headline number will still be large in terms of inflows, but if you just map pure secondary market inflows, I think that's not a pretty picture. More alarming is the way the Nifty futures shorts are being piled up now. Yesterday was almost a 4,000 crore net sell figure. That's nearly $1 billion in a single day of Nifty futures being sold, $800 million odd. That's a large number, and there has clearly been some fresh short build-up in the system. There is one positive aspect to it, of course, that if the market recovers, these shorts will be quick to cover, and they might lead some amount of pace to the rebound too. But it's a little unsettling to see the kind of short build-up which is happening from the global guys. Also interesting is the fact that this whole rally over the last few weeks has been a mid-cap rally and a small-cap rally. And to that extent, we have seen a fair degree of pile-up in stock futures. Now, we didn't see any great unwinding of stock futures yesterday in the fall. We saw a bit of short build-up in some of the weaker counters, which is why the open interest has gone up. But if this continues, could there be a leg of a big mid-cap unwinding or stock futures unwinding? So I think the threat, the Nifty is being hammered by the global guys. But if the Nifty is to go below 5,000, the element of the market which will undergo a severe test is those mid-caps, particularly the liquid ones, where we've seen quite a bit of a pile-up. So I think that element needs to be kept in mind, because the money in the market has been just in the broader market. It's not been in the Nifty. So the real hurt will come in if mid-caps start to correct big time. We saw a small element of that, but I don't think we have seen a major purging of mid-cap positions. Hopefully it will not happen, but sub 5,000 the threat looms.
It's also worrying, Udayan, that the market is not only bereft of global money but local money as well. I mean, if you scratch that DII participation, even for them a big chunk is courtesy primary or treasury buys.
That it is, and it's the best quarter for insurance companies, January to March. And the reason why the Nifty has been holding these 5,200 kind of levels is because the insurance money continues to support the market. I think you'll still find that if the market corrects some more, the insurance companies will deploy more money, because this is when they are flush with cash, they get the cash in this current quarter, and they do not take large cash calls. So this correction might actually come as a bit of a help for them, and they may latch on to it and support the market. But, you know, let's take it one step at a time. Let's see what the markets are about to do now, because it's difficult to game. The last few corrections have been very shallow. If this is one more of them, and you dip to 5,000 and get back into the trading range, that's fine. I mean, that's no skin off anyone's nose. But things are unpredictable. You don't know how globally things pan out. And in this, to just map liquidity and say the markets will get supported, because liquidity has a habit of chasing prices and vanishing when you need it most. So I mean, it's a bit dangerous to just map support levels keeping liquidity in mind.